And it will be available for future viewing on the San Diego North website, www.sdnedc.org. Again, I'm the Chief Executive Officer here for the SDNEDC. We're the only economic development entity that works exclusively in North County, San Diego, trying to grow our economy and create greater prosperity. And one of the things that we do is we try and provide educational resources to businesses that are located in our region, part of which is this webinar that we're doing with Magnus Blue. Before I turn it over and hit my mute button, again, good Zoom etiquette, mute yourself. We will do questions and answers at the end. We would just encourage you to do it in the chat box. That makes it easier rather than trying to do the hand calling and everything else. And then again, I would tell you that we're doing one of our year-end big luncheons on December 15th at the Seabird Resort in Oceanside, a great facility if you haven't had it. That's our awards luncheon. If you're interested in finding information, you can on our website, and we're at 78% sold out. So I think I've got 80, maybe actually less than 80 tickets left. So please don't delay if that might be of interest to you. It's a great time and a wonderful networking event. Today, we're joined by two speakers from Magnus Blue, a firm that we've worked with at the council for a number of years and which is an investor. We're going to hear from two of their tax experts. We're going to hear from Jack Shirley. He's a CPA and a partner with Magnus Blue. He holds a bachelor's in accountancy and a master's in computer information systems management. He began working with the preceding firm, Polito and Epic. In 1999, he worked for another CPA entity for a number of years, and now has merged his business with Polito and become Magnus Blue LLP, located here in San Marcos. In his free time, he enjoys spending time with his family, as well as basketball, cycling, reading, playing piano, and gardening. He has a knack for killing vegetable plants, and that's something we have in common. And he enjoys working with clients and helping them pay as little taxes as possible. Actually, that's two things we have in common in terms of enjoying them. And then Jessica Dorset, she's a manager with Magnus Blue. She graduated from the University of San Diego with a bachelor's of accountancy. And after being recruited on her wedding day, I didn't know that. And knowing Jessica, she's such a great person and dedicated professional. I can totally see her balancing those two calls at the same time, those two things, those balls in the air. She began her career with Polito, where she spent the next 17 years experiencing all aspects of public accounting. Today, she manages part of the firm's client relationships and helps support the tax department in its continued efforts to remain current and ahead of the ever-changing world of tax. So with that, I'm going to turn it over to Jack, and we'll do some screen sharing and all that. And again, if you have questions, please put them in the chat box. With that, Jack, over to you.
Great. Thank you very much, Eric. Jessica and I really appreciate this opportunity to share some of our thoughts on the new tax law. Also, Jessica suggested, and I think it's a great idea, that we just tell you just a little bit very quickly about our firm. You know, our firm not only has a robust tax department, but also an audit department. And many people have asked us about our name, Magnus Blue LLP. It's kind of a different, strange name for a CPA firm. So essentially what happened is when we were starting back in 1999, well, actually the firm started before that, but I became involved in 1999. After about 3 or 4 years there, we had some differences in vision and opinion, and we split into two different companies. But luckily for us, over about an 18-year period, we stayed connected. We went out to lunch periodically, remained friends, referred business back and forth. And a few years ago, we started discussing whether or not we should merge back up our firms. And we finally decided we never should have separated in the first place. So we came back together to create one firm again. And something really nice about this situation is we decided we wanted to come up with a name that did not focus on the individual partners, but that focused on the entire community we have built. And so we came up with the name after a lot of work, Magnus, which means great, in Latin, and blue, which being by the ocean means potential, expanse, wisdom, togetherness. So that's why we have the name of Magnus Blue. So that's just something very quick about our company. And at this point, I'll turn it over to Jessica to get us started.
All right. Jack, can you confirm the screen is correct? Good. Okay. Just want to make sure. All right. So we are here to primarily talk about the Inflation Reduction Act. We are going to focus mostly on, on business sections, or there are some personal items that we wanted to discuss because they could affect business owners, in particular those with pass-through entities. And so we've kind of got a little bit of individual and business. Then we're also going to talk about some tax planning reminders for year end, since we are coming up to our calendar year ends at least. So that's kind of the flow of today's presentation. All right, so the first part we want to talk about is our clean vehicle credits. This has replaced the existing or the previous, basically the electric vehicle credit that we were kind of used to up until this point. This goes into effect for all vehicles purchased after this year. So after 22, there is a removal of the 200,000 per vehicle manufacturer phase out. So that no longer applies. But what they did do is replace it with some requirements that the vehicle essentially be made mostly in the US or US friendly countries. So that is the components and the production and the final assembly. For purchases made for the rest of 22, the credit is pretty much the same as what it was before, except for it does have to be assembled. The final assembly needs to be in the US. So there are definitely some changes to be aware of. And the biggest thing why we wanted to bring this up is the fact that they've now got this AGI limitation. AGI is your adjusted gross income. And there's a chart later that will show you where those numbers come in. But if you are an owner of a pass-through entity, an S Corp, an LLC, a partnership, something like that, all of your business income shows up on your personal 1040, and that's going to bring up your income quite a bit, especially if you're a profitable business. And that might phase you out of your opportunity to claim this credit. So you've kind of got a small window left. That AGI limitation doesn't go in effect until 23 next year. So if you're interested in an electric vehicle or a clean vehicle, it was something you're thinking of doing, hadn't pulled the trigger yet, you may want to look into doing that before year end if your AGI is going to phase you out. We'll see those numbers in a minute. There's also a price limitation. So vehicles, we're not going to get a credit on the really expensive vehicles, and you'll see that in a minute too. So there is some transition relief, and you'll see a chart that kind of talks about that. And the big thing is to realize that there's a VIN, every car has a VIN number, right? We're gonna have a lookup tool because you're actually gonna have to put that VIN number on your tax return to claim the credit. So if I've got one piece of advice for you before you purchase any vehicle, if you are trying to get this credit, look up the VIN number before you buy it. You will be able to confirm if the vehicle qualifies on that lookup tool, and we've got a link there for you. This credit is only qualifies if the vehicle weighs less than 14,000 pounds. I think that was that one. The maximum credit is $7,500 if it meets both the critical materials requirement and the battery component requirements. So there are specific numbers to look at. And again, I'm not going into the details here. I just want you to be aware that these are the requirements in order to qualify for the credit. Our expectation would be that the dealers are very well aware of this. Again, I'm going to tell you, look up that VIN number before you buy the vehicle. Make sure you're confident that the credit is going to be available to you. For 2022, the base credit is $2,500, and then there's an additional $5,000 based on the available based on the battery capacity. Now here are those limitations we were talking about. So if your modified adjusted gross income for a married filing joint couple is 300,000 or more, again, that includes any flow through business, rental properties, anything like that, that's on your personal return. If it's above 300,000, you will not get the credit. It is a cliff calculation, a cliff threshold. So $300,001 of your modified adjusted gross income credits out. So you can see the caution here. Really be careful if you've got those K1 incomes. There is a price limitation. So after this year, the retail price cannot exceed $80,000 for vans, pickups, or SUVs, or $55,000 for everything else. There are no provisions for inflation on this. So those are not going to adjust. And then if I'm just going to go ahead and ask everyone can mute themselves, there is some background noise coming through. I'd appreciate that. Thank you. So which rules apply when? This is a chart. And again, we're going to send out these, we'll send out the PDF of this slide presentation after the fact. So you'll have access to these slides for all of these charts that you're going to see. So I'm not going to go into these in detail. But basically, you know, depending on when you purchase your vehicle, if you got it before August 16th, 2022, that was the date that the act went into effect. The previous rules apply. If you got the vehicle between now and the end of the year, you've got a modification to look at, and then starting 22, the next rules apply. The new rules apply. Did I skip? No, okay. So what is new is that there is now a used vehicle credit for these electric vehicles. This is brand new. We've never had this before. Keep in mind, it has to be sales that are done through a licensed dealer. So individual sales will not qualify. Buying it from your brother or your neighbor, think that will not qualify. Vehicle needs to be sold for $25,000 or less. And it only qualifies for the first resale of the vehicle. Meaning you're buying it from an original owner. You can't buy it from a second, third, fourth owner. The credit is calculated as 30% of the sales tax with a maximum $4,000 credit, which would be $16,000 purchase. So basically, anywhere between, if you're purchasing a vehicle between $16,000 and $25,000, your maximum credit is $4,000. Below that, it's going to be 30% of the price. The AGI limitations here are cut in half. So a married filing joint couple of $150,000 or less can utilize this credit on a used electric vehicle. Above that, you're out. The qualifications for the vehicle is that the vehicle's model year must be 2 years earlier than the calendar year in which it was purchased. So if you purchased the vehicle in 2022, the vehicle year would have to be 2020 or older. The original use may not commence with the taxpayer, so again, it has to be used. We have to have the same qualified vehicle requirements, except for it doesn't have to be final assembly in North America. So that's an exception. And then it does still have to be less than 14,000 pounds. On this credit, you can only claim this credit once every 3 years from the date of the purchase, not every 3 calendar years. So if you bought a vehicle today, for example, the used vehicle today, you'd have to wait 3 years from today in order to claim that credit again. One of the things I thought I put in here, but I either glanced over it, didn't notice it, is these credits are actually allowed to be transferred to the dealer starting in 2024. So after next year, the following year, they're allowing the buyer to transfer the credit to the dealer versus taking it yourself on your 1040. This effectively would reduce your purchase price, right? Because you could use it almost like a down payment on the vehicle. The problem is your qualifications, including your AGI limitations, are still all in effect. I can see this being an issue. What we don't know yet, and there's going to need to be some guidance from the IRS, is what happens when the purchaser, so like if I don't meet the the AGI limitations, but I took the credit and used it to, against my purchase, the dealer is not on the hook for it. I'm on the hook for it because it was my responsibility to make sure I qualified for it. And so how that's going to be reconciled, we don't know yet. I think dealers might be cautious in taking these credits and taking that responsibility themselves until there's more clarification from the IRS. But you also don't want any big surprises on your tax return. So you can expect your preparer, if you're claiming these credits, your preparer is going to be asking you for a lot more information. We need VIN numbers, we need purchase contracts, we need to make sure that everything's checked and that there's no surprises. Okay, another new one, or slightly modified, I should say, is a qualified commercial clean vehicles credit. This is really for the businesses. So this is a credit that is equal to 15% of the vehicle's basis or purchase price, more or less. 30% if it's not being powered at all by gasoline or diesel. So let's use a $120,000 truck purchase. Let's say you're getting a clean vehicle, maybe like an F-150. You purchase it for $120,000, a 15% credit would be $18,000. Then we have to look at because there's a lesser of here, the excess of what it costs you to buy that F-150 as a clean vehicle versus a regular gasoline or diesel powered F-150. Let's say that cost you $100,000 if that was the regular price for that. So that difference, that increase that you paid for the electric vehicle or the clean vehicle, I should call it, was a $20,000 difference. So your credit would be capped by that differential. So in this case, you would take the full 15% or the $18,000 that I calculated. The maximum credit here is $40,000 or $7,500 if the vehicle weighs less than 14,000. We saw that just a few slides ago for the individual tax credit as well. The vehicle must be subject to depreciation, meaning you have to capitalize it. So that's kind of an accountant use word, but if you're, for example, a contractor and you normally job cost out your vehicles or something like that, and you never actually put it onto your balance sheet, then you wouldn't be able to qualify for the credit. You also are subject to credit recapture, which means if you can't do like a workaround to go and buy yourself a big truck, take the credit and then distribute it out to yourself as an owner, right? And you got this big $40,000 credit, but now you're taking it as a personal asset. It has to remain as a business asset. And you do need to reduce the basis. So in my previous example, if we purchased that truck for $120,000, we got an $18,000 credit, we're actually going to put that on the books now as a $102,000 vehicle asset. There were a few changes to some non-business energy credits, and I just wanted to make you aware of them. I'm not going to go into these because this was meant to be focused primarily on business owners, but I did want you to be aware of these credits that have changed or have been added, mostly changed from the previous rules. And then these are some slides that go into those. So again, you're going to have these slides. I'm not spending time on these. I just wanted you to have this information. So I'm going to go ahead and just kind of breeze through these. And Jack is going to talk a little bit about the solar credit.
Wonderful. Thank you very much, Jessica. I'm so glad that we are continuing the tradition of having tax laws that are as complex and confusing as possible. We have nicknamed this act and others the Accountant Employment Act. So thank you very much, Congress. We'd like to talk about some credits and also one deduction, and we'll start with this residential clean energy credit. Most people know this and they call it the solar energy credit because the way most people take advantage of this credit is by installing solar on their home. But the law actually includes qualified fuel cell property, wind energy property, heat pump property, and others. So if you see your neighbors start to install a windmill or something on the side of the house, you'll know what's going on there. So under the old law, this credit was being reduced from 30%. In 2021, it was down to 26%. but the new law brings it back up to 30% and also extends it all the way through 2032. So there's plenty of time to take advantage of this. And also any solar or other residential clean energy property that was added beginning in 2022 also has that same 30% credit. So that's really nice. Just to give you an idea of what that means, first of all, a credit is a dollar for dollar reduction against your actual federal tax. So if you add solar panels for, let's say, $30,000, and you take 30% of that, or $9,000, that $9,000 reduces your actual federal tax. That's really nice. So going down below, battery storage technology. This is something that is new in this law. The law adds battery storage technology to the list. Many people are saying, finally, because what good is it if you have solar and you can only use it during the day when the sun's out? So now if you install a battery that has at least 3 kilowatt hours and you store that electricity during the day for use in the evening, the cost of that battery can also be added for purposes of this credit. So you can take a 30% credit on that as well. That's really nice. The last point there is that the credit is non-refundable, but it carries over. This is usually pretty confusing to people. So let me give you an idea. Let's say that when you owe your taxes, you owe $5,000 of taxes, but you have a $9,000 credit. So the $9,000 credit completely wipes out that $5,000 of federal tax. But what happens to the additional $4,000? Congress says, no, we're not going to give that to you now, but we will carry over to a future year that $4,000 so that you can use it against your tax in future years. So it's actually quite a great deal. Just one more point I wanted to add for this slide, just maybe a little warning or caution. You'll hear there are a lot of smaller solar companies, some large, some small, that are going around saying, hey, if you hire us, not only can we add solar to your home and you can take advantage of this credit, but we can redo your entire roof and you can add the entire roof as cost in terms of the credit. So you can take a credit for 30% of the cost of the roof. The actual law doesn't say that, but the actual law says, in short, is that if you have to make minor adjustments to the roof or minor repairs to the roof in order to add the solar panels or the other clean energy property, that you can essentially add that into the amount of this, of the cost for purposes of this credit. So just be aware, you'll probably hear that out there. Jessica, do you mind going to the next slide there?
Yeah, one more thing we did want to touch on though was that this doesn't have to be on your primary residence. So if you have a second residence, for example, a vacation home, you can put solar on that one as well and qualify for the credit.
That's an excellent point. So as long as it's personal use, it cannot be a rental property that you're renting out to somebody else, but personal use, as Jessica discussed. Thank you. All right, the energy efficient commercial buildings deduction. This may not apply to some of you, but it may. So we'd like to spend just a few minutes on this. A quick point is that this is a deduction, not a credit. That's very confusing to people. So let me briefly explain. A credit is a dollar for dollar reduction against the actual tax that you pay. A deduction, on the other hand, is a dollar for dollar reduction against the net income of your entity or your adjusted gross income. So you reduce, with a deduction, you reduce your taxable income and then you pay tax at a certain percentage on that taxable income. So if that makes sense, this is a deduction, not a credit. So this deduction is beneficial for those who may own a commercial building, but it's also available for those who may be looking into build a building, or even for those who are leasing a building and want to pay for those improvements themselves. Usually improvements made to commercial property have to be capitalized and depreciated over a number of years. So this law for efficient commercial building property accelerates that deduction. It's also available from now until 2032. So lots of time for this. Now, in order for any of the expenditures for these improvements to qualify, they have to be within one of three different systems. One, it has to be interior lighting, or your heating or air conditioning, or within the building's envelope. Well, that's kind of a strange term. What does that mean? So kind of like an envelope wraps around a letter, the envelope of a building wraps around the interior. So that might include things such as the roof, walls, the foundation, doors, windows, insulation, among many others. Usually those types of improvements, believe it or not, have to be expensed over a period of 39 years. So this is really nice to be able to accelerate some of that deduction. So how does this work? Well, it's not easy. It's very complex. First of all, the deduction needs to be computed using qualified software that is certified by the Secretary of the Treasury. And you start with a base deduction on this, but then the base deduction is increased per square foot depending on the amount of reduction in energy usage. And there are multiple other limitations as well. So you're probably thinking to yourself, this is really complex, and you'd be right, it is. So really, before you get into these type of improvements, you really need to talk to a specialist in this industry to help you determine what materials qualify, what improvements qualify, and what you might be able to take as an additional deduction. But just to give you an idea, a base calculation, which we have there on the slide, is up to $1 per square foot. So you make improvements and then you get a deduction up to $1 per square foot. But there's also a bonus deduction if you meet certain wage requirements and apprenticeship standards. Well, what are those? Well, remember that one of the purposes of the Inflation Reduction Act is to create work opportunities for certain laborers, mostly union workers, not completely, but a lot of them. And so if while you are constructing these improvements or making these improvements, if you hire certain laborers or mechanics or certain qualified apprentices and you pay them a prevailing wage, you may be able to take a bonus deduction for these improvements up to $5 per square foot. So that really ups the ante there and makes it much more worthwhile. Jessica, anything you want to add to that slide?
Nope.
Wonderful. All right, other credits. You can see by the lack of detail on this slide that we're not going to spend a lot of time here, but we just wanted to give you a quick snippet for each of these credits, just so that you have them in the back of your mind. If one of them sounds intriguing, you might wish to make a note, and you can follow up with us later. We're happy to send you additional information on any credits. So first is the alternative fuel refueling property credit. I kind of sit here and wonder, who is the poor soul in the congressional subcommittee who is responsible for coming up with the names of these credits? I hope they're paid well. So that's a little complex, the alternative fuel refueling property credit. So this credit actually had expired at the end of 2021 and is now extended through 2032. So you can receive a 30% credit for alternative fuel refueling property. Well, that property has to meet some fairly tight specifications, but just to give you an idea of the types of property this might include, if you were to install an electric charging station in your home or your business, you would likely qualify for this credit. So on to the next credit, the new energy efficient home credit. This credit also had expired and is now extended through 2032. The name itself is a little misleading because of the home component. It is actually not, homeowners are not qualified to take this. It's actually for those who construct or reconstruct homes. The credit actually is granted on a per home basis. It's a little complex, but the contractor who's building the homes or even the manufacturer of some of the parts can receive a credit on a per home basis starting at about $500, but all the way up to $5,000 per home, which is not bad for a credit. So it really depends on the type of home that's improved. So the next, actually, let's lump these last two, the renewable electricity production credit and the energy investment tax credit. These two credits are somewhat related, kind of like two sides of the same coin. So the renewable electricity production credit is available to companies that construct facilities that produce electricity. And then they sell that equipment or those facilities to other people. Minor changes were actually made in the law to allow smaller companies to enter this market. We'll see if that works. And then the energy investment tax credit is kind of like the other side of the coin. It's available to companies that invest in specified energy properties. So they take advantage of this property that has been constructed. Jessica, anything you'd like to add to those?
Nope, great job.
All right, pass it back to you. Thank you.
All right. So there's been a lot of buzz in the media about the increased funding that came along with this act. We want to try to demystify some of that. You can find the funding. There's a long list of things, and they're very specific as to what they're supposed to be funding. So it's not as if it all went into new audit agents. So they are increasing taxpayer services, which Jack and I can attest to has been awful the last several years. Please give your CPAs patience if they are calling the IRS on your behalf. It's challenging right now. So we as professionals welcome that additional funding, and we'll hopefully see improvement. They are increasing law enforcement. So everyone is concerned that means a lot of new audits. That's yet to be seen. If there are going to be a lot of new audits, it's going to take a while to train them up, to hire them and train them. So it's maybe a little premature to start getting too concerned on that one. However, we always advise our clients, always be audit ready. Make sure you're using best practices when it comes to document retention and record keeping. You do not want to be scrambling 2 years later if you get a notice trying to get all your documentation together. But they will be increasing their efforts on the digital asset monitoring. And we've been hearing that for a while now in our profession. You may or may not know this, but on your 1040, on your personal tax return, you actually have to explicitly answer a question: do you have cryptocurrency or digital assets? Yes or no, or do you engage in it at all? So they're definitely working their way towards that effort. They are going to put a lot of money into technology development and modernizing their systems. They are using systems that were created back in the 1970s. They are incredibly out of date. And so this is very much so an area that is needed for additional funding. And I think that will make a lot of improvements across the board with the IRS. All right, so we are now actually going to exit the world of the Inflation Reduction Act, and we want to touch on a few things that you may or may not have heard about this year. This California pass-through entity elective tax, which is commonly referred to as the PTE, was big news in California for pass-through entities. You hear this a lot in referenced in the media if there's this SALT limitation. This happened a number of years ago where in the TCJA Act, where the limitation on itemizing your taxes was capped at $10,000. And this really, in particular, affected pass-through entity owners because they pay tax on all of their company's income on their personal returns, which includes paying all the California or the state tax. And before they could deduct that, just like a corporation would deduct their state taxes on their federal tax returns, they could deduct it on their federal returns or as an individual. And this cap really penalized them. And so the states have been working, a lot of states, in particular the higher tax states like California and New York, have been working on how can we get around this. And the IRS finally approved this approach. Essentially what happens is I'm going to use an S Corp as in my example. The S Corporation pays a 9.3% tax at the entity level on behalf of its shareholders. It is deducted on the federal return on the S Corp's return. So it comes through with a reduced federal ordinary income for the shareholders on their K-1. The payment then also goes through on their California K-1 as a tax credit. So they get that payment to apply towards their California taxes. And Jack explained the difference between deduction and credits, so you can kind of follow here. So now we have that tax credit on your California return to offset your California taxes. There are a few cautions here. It's not refundable. He explained that. So if you paid $10,000 or you had have a $10,000 California tax credit coming through now from this PTE that was paid on your behalf, but your California taxes are only $8,000, you've got $2,000 unused, but it's been paid in. It actually carries forward for 5 years, but if you don't use that within 5 years, you do lose it. And so there's planning that needs to be done in the event that you're not able to utilize all of it. However, if you are able to utilize all of it, it is absolutely recommended to be using this election, I guess we can call it, because otherwise you're missing out on the federal tax benefit. You're paying the California tax regardless. So it's not as if you are paying any less California tax, it's just being paid in differently. But instead now you're getting that federal reduction. Now, not all owners have to participate, and in a partnership structure, that's really easy for us to deal with on a tax return because we can specially allocate to the partners that participate and those that do not. However, that's not the same rules when it comes to S Corp. So when you have an S Corp taxed entity, you really want to be cautious and aware of how that may work on a return where not all owners participate. And it really does not make sense for everyone. So it's definitely not something that everyone should just jump in both feet without considering the impact on your return. I've had a number of clients where there was a very rash decision made in the tax year, in the last year. It was, sorry, I'm fumbling this, in the 2021 tax year, because this came out in the springtime, this election, and there was like last minute decisions that were made, and I had a number of them where I had to explain, you're not actually going to be using all of that, and we really don't want to make that election next year. And I explained why. In particular, if there's owners that are outside of this state where they don't actually pay a lot of California tax, or maybe there are other individual issues that bring down the taxable income and they're just not using all of it. You don't want to lose that money. To participate for the current tax year, 22, you had to make your first payment by 6/15, by June 15th. So if you didn't make that payment and there was a calculation that had to be done, then you're not able to participate for this calendar year, but you can next year. It resets again. If you did make that June 15th payment, the remainder is going to be due by March 15th of next year. And if you are a cash basis entity payer, you may want to consider paying that by December 31st so that that deduction comes through on the 22 tax return. I won't get into the semantics of that, but it's just kind of a word of caution. Another area that is really going to start surfacing a lot more, in my opinion, is the multi-state taxation issue for businesses. We call this Nexus. COVID really emphasized this issue in our country, really across the world. We've got remote workers, we've got customers across the nation. When that happens, you are potentially causing your business to be taxable in those other states, not just California. So even though you may have your business primarily in California, there are certain activities that may trigger you having a tax reporting requirement in another state. And other states are becoming more aggressive on this issue. California is one of the more aggressive. So if you're already in California, which I assume everyone on this call is, then you're already paying tax to California. But you want to be aware of these so that when you're making these decisions, you're aware of the potential tax impact it may have on your business. So if you have remote workers outside of California, or if you have an office or a sales team in another state, if you're service-based revenue, where are your customers? Are they in California, or are they in New York, or are they in Texas is an interesting state, for example. They're pretty unique in their taxing approach. Currently, if you have sales of tangible items, you sell the widgets, the knickknacks, whatever, that is currently protected by Public Law 86-272 for now, but there's definitely some states that are aggressively attacking that one. Currently, the law says that if you are selling tangible items outside of your state, that those other states cannot come in and try to tax you. These rules, I should mind you, are just for income taxes. Sales tax laws are completely different, and you'll hear the reference to Wayfair, which completely changed the world of sales taxes. So keep in mind, I am only talking about income taxes for this presentation. So you want to be aware of these possible triggers. Now, just because you have to file a tax return in that state doesn't necessarily mean that you will be taxed in that state, because the way they establish nexus, which is what's going to say you have to file a return in that state, is not always the same way they determine how they tax in that state. California is a good example of that. If you have an employee in California, but you're an out-of-state business, let's say you're a Nevada-based business and you have an employee in California, California is going to tell that Nevada-based business, you have to file a tax return. But if they have no revenues coming from California, California sourced revenues, they will have no actual taxable income in California, because California's apportionment is solely based off of your gross receipts and where they're sourced. So that can definitely happen. But it doesn't mean you don't file a tax return, especially California. They still want their $800. So, so you want to be aware of those. There are tax planning considerations here. There's definitely cases where you might be taxed twice on income, and there's potential situations where you may not be taxed on all of your income because of these differing states and how the apportionment works. Each state's different. There is no one size fits all, and it's challenging as tax preparers, because we have to go and constantly check all the other states because these laws are changing frequently. But I wanted our audience to be aware of this issue, because I firmly believe this will be a growing issue in the world of taxation on businesses. All right. Jack is going to finish us up with a few oldie but goodies. I like to call them tax planning reminders for year end. And feel free to take these to your CPAs and discuss how you can save taxes for the current year.
Perfect. Thank you very much, Jessica. I agree. You may already know about these, but if one gets into your mind, jot it down and ask your CPA about these. So I'll go through these fairly quickly. Bonus depreciation and 179 expensing. If your company needs new equipment or furniture for next year, but you can buy it this year, it might be very worthwhile, especially if you have a lot of income in 2022, because you might be able to take all or a great portion of that property as a full deduction in the current year. Be aware that there's a lot of talk out there of buying a large vehicle that's over 6,000 pounds and how you can take 100% deduction. That may be true. Just talk to your CPA. It may not be true. I had somebody try to buy a really sleek 6,500 pound Porsche, and it was a beautiful Porsche, but it didn't qualify. So just keep that in mind. Retirement plans, make sure you know the rules on those retirement plans. For example, on a 401k, you need to make your contribution before the end of the year, or you may have other types of plans, a profit sharing, a SEP IRA, a DB plan. There are multiple different types of plans where you can actually take a deduction in 2022, but not have to make the contribution until later in 2023. So just be sure you know the rules. And also, if you don't have a retirement plan, it might be a great idea to get one, depending on your situation. But it's likely that it needs to be set up before the end of the year. So make sure that you talk to your CPA about that now, and he can put you in contact with somebody who can help you set up there. All right, cash basis versus accrual basis. Most of you are probably operating on the cash basis, so you don't need to worry about this, but you might be an accrual basis entity, especially if you have inventory or you're a manufacturing company. So if so, just keep in mind that on the accrual basis, there are some items that you can pay for in 2023 but put into your accounts payable and take a deduction inside 2022. There are some specific rules about that, but just keep that in mind. All right, year-end bonuses. Depending on your type of entity, you may wish to pay yourself a payroll bonus at the end of the year or to your key employees. Not only is this a great opportunity to take a business deduction for the full amount of the bonus as well as payroll taxes, but it's also a great way to get some money out of the company and into the pockets of your pockets or key employees. It might also be a great way to pay some tax at the end of the year if you have not paid in enough tax during the year. If you usually have a quarterly estimated tax requirement and you're behind, but you don't want to pay those penalties, you might be able to pay some tax, some income tax for federal or California through this bonus. And the IRS in California assumes that that tax that you paid through the bonus was collected throughout the entire year. So that's kind of a nice little benefit there. Paying expenses on credit cards. This is especially nice for cash basis taxpayers. If you buy something on a credit card in 2022, but you don't pay it off till 2023, you can still fully deduct that item in 2022. Maximizing your QBI deduction. QBI stands for Qualified Business Income. The tax law changed back in 2018 that allows certain entities to take an additional deduction equal to 20% of the net income. It's not available for C corporations, but most other entities, depending on some factors, can use this deduction. So there are limitations on how much overall income you make as an individual because it's taken, this deduction is taken on an individual level, and also depending on what you do. Certain professionals have a limited deduction, such as us. We were penalized as accountants for this. We can't take as much of a deduction as some other entities. But there might be some things you can do now to adjust your income or defer some income or accelerate some income even so that you can take advantage of this deduction. Reasonable compensation. This is always a buzzword for those who have S corporations. Those who have S corporations know that the law requires owners to take a reasonable compensation. You have to do this. Ideally, you would be taking this on a monthly basis, but the IRS has not cracked down on this too much yet. So many people like to take a bonus to meet their reasonable compensation requirements before the end of the year. So you can meet this requirement and potentially still save some tax. The whole idea of a reasonable compensation is a little strange. You really don't want to pay yourself too little because then the IRS comes and looks at you, but you don't want to pay yourself too much either because then you're paying more in tax than you have to. So be sure if you're an S corporation that you talk with your CPA about reasonable compensation. Finally, net operating losses. Net operating loss is a business or tax deduction that is not deductible in the current year, but that carries forward to the future years, not a credit, but a deduction. So if you had a business that lost some money one year and you were not able to take advantage of that entire loss, you don't lose it, it carries over to future years. Now, during the pandemic, California limited the amount of net operating losses that could be carried forward. But just in early 2022, our governor changed that law. So in 2022 or 2023, you might have some California net operating losses that have been sitting there or been generated that you can now take advantage of. So be sure to look at those. And I'm sure there are also some other carryover losses that you may or may not have, such as on the sale of securities. Most people made money in 2021, and most of us have lost money in 2022. So this may not be a big deal for 2022, but it might be for 2023 and forward. Jessica, anything you want to add on that slide?
No, the only other thing with the net operating losses was for federal purposes, we can only, how do you explain that? We can only reduce up to 80% of your income by prior year net operating losses. So even if you've got large NOLs from the prior year, you're still going to be paying tax on at least 20% of your income.
Great point. Thank you.
All right, well, that does it for us. We'll go ahead and end this. I'm going to stop the share. There we go.
Perfect.
All right.
thank you, Jessica and Jack. That was great to go over and help people sort of think through a variety of things. As you said, Jack, it's the Full Employment Act for accountants, so I know there's complexity. If you have any questions, feel free to put them into the chat window. We have one, and I think you guys answered that, but just make sure. So for the vehicle credits and so forth, those are really only for whether it's fully renewable, fully electric, or hybrids, or that it's a set of cars that are designed around carbon emission reduction, right?
Correct. Yep.
And as you said, Jessica, thank goodness they put in now a thing that you can put your VIN numbers in and not have to rely upon the dealers.
Right. So I saw a follow-up question. Tesla qualifies because Tesla had phased out, right, because of the 200,000 max vehicle. Technically, yes, those would come back on board as long as they don't exceed the $55,000 per car, right? So I know Tesla has a few trucks and SUVs, but mostly you see cars on the road. I don't know how many of those cost less than $55,000. Maybe a few.
I think some of the Model 3s do. So yeah, I think Rosie's question is that, you know, that would be one to look at the price and then also put in the VIN number.
Put in the VIN number,
where the dealers are. Any other, before we wrap things up, any other questions for our two panelists that people may be thinking about?
I did have a question. You mentioned something about the $300,000 filing married joint taxes. And so is that only for your business, or does that also include your W-2 job?
It includes your W-2, includes all of your income, investment,
all your income.
Yeah, all of your income.
Gotcha. Okay, thank you.
Mm-hmm.
Great question.
Yeah, absolutely. Any other questions that are out there? Perfect. My question, which would be puckish, so I won't ask for a response, is why we're calling this the Inflation Reduction Act, but that's okay. You know, it's just like, it's interesting. It's interesting in this use of words, but okay. Oh, and here's another one that came in. For the alternative fuel refueling property credit, we have a charging station that was built a couple of years ago. Would that qualify, or does it have to be built during in this year, or, you know, in the tax year that it's being claimed in?
Great question. So it likely did qualify depending on when it was built. So that's not a brand new tax law. It's just been extended under this new law and adjusted somewhat. So depending on when it was built, I'd go back and ask your CPA what the tax law was in that year. It's possible that you did take the credit. It's also possible that you didn't, and maybe you can go back and amend.
Got it. So so Jack, it is very similar, or it's analogous, maybe not very similar, but analogous to extensions that we've seen in R&D tax credits, where there's an expiration that's expected, and then Congress has pushed out that deadline further out.
That's correct.
Perfect. Any other questions that people might have? Okay, seeing none and seeing no hands up, I want to thank everybody for attending. Again, we will send out to all of the people, both those that are on the call right now, and as well those that registered, the slide deck that was involved, as well as a link to this presentation, which will be up, I hope, out before the end of the day today. We want to thank you. I am sure that in 2023, we'll be doing a human resource law update, employment law update, because those, again, the California legislature is always busy, it seems. So there have been some changes that are important for employers to know. And again, I want to thank Jessica and Jack both for being presenters today, and then their longstanding support for economic development in North County.
Thank you.
Thank you. Have a good day.
Sign off and have a safe and dry day.